This year, Warren Buffett will collect approximately $6 billion in dividend income. Not from selling stocks, not from trading, not from any active decision he will make in 2026. Simply from holding stocks he bought, in some cases, over 30 years ago. Coca-Cola will send Berkshire approximately $776 million in dividends. American Express will send over $300 million. Chevron, Bank of America, and Occidental Petroleum will each contribute hundreds of millions more. Buffett has not sold a significant position in any of these companies in years. He simply holds them, and every quarter the dividends arrive, compounding at rates that now generate returns on his original cost that most investors would consider extraordinary. In this video, I'm going to walk you through the 5 principles behind Buffett's dividend strategy, how he built a portfolio that generates billions in passive income annually, why the strategy works differently than most dividend investors understand, and specifically what makes his approach to income generation so much more powerful than the conventional wisdom about dividend investing. Lesson 3 is the one that will permanently change how you think about dividend yield as a metric. Stay with me. Before we get into the 5 principles, there is one concept that unlocks everything else in this video. It is called yield on cost, and most investors never think about it. When financial media or investment platforms report dividend yield, they report it as a percentage of the current stock price. Coca-Cola today yields approximately 3%. That means for every $100 of Coca-Cola you buy today, you receive about $3 in dividends annually. But Buffett did not buy Coca-Cola today. He bought it between 1988 and 1994 at an average cost of roughly $3.25 per share, adjusted for subsequent stock splits. Coca-Cola's annual dividend today is approximately $1.94 per share. On Buffett's original cost of $3.25, that $1.94 dividend represents a yield on cost of approximately 60%. Not 3%, 60%. Every year, Berkshire receives dividend income equivalent to 60% of what it originally paid for its Coca-Cola shares. In perpetuity, without selling a single share, without any further investment required. This is the foundational insight of Buffett's dividend strategy. The yield you care about is not the yield the market offers you today. It is the yield your original cost will eventually earn as dividends grow over decades. And the only way to reach that extraordinary yield on cost is through the 5 principles we are about to cover, because most stocks never get you there. By dividend growers, not high yielders. The principle. The most common mistake dividend investors make is chasing high current yields, buying stocks that pay 6, 8, or 10% dividends today at the expense of dividend growth. Buffett does the opposite. He looks for companies with relatively modest current yields, often 2 to 4%, but with a long history of growing their dividends consistently year after year. The mathematics of why this matters are powerful. A stock paying a 6% dividend that never grows will still be paying 6% in 20 years. A stock paying a 2% dividend that grows 8% annually will be paying approximately 9.3% in 20 years on the same original investment. And that 9.3% is applied to an original cost that has likely also appreciated significantly. How Buffett applies it. When Buffett bought Coca-Cola in 1988, it paid a relatively modest dividend. But Coca-Cola had been growing its dividend consistently for decades, and Buffett's analysis suggested it would continue to do so, because the underlying business had the pricing power, the global growth runway, and the capital-light economics to grow earnings faster than most businesses. He was buying future dividend growth, not current dividend income. The current income was small. The future income, compounded over 30-plus years of consistent dividend increases, is the $776 million annually that Berkshire now collects. The same logic applies to his American Express position. Not a high-yield stock in 1964, a consistent dividend grower over 60 years that now generates extraordinary returns on original cost. What you do. When screening for dividend investments, prioritize dividend growth history over current yield. Look for companies that have grown their dividend for at least 10 consecutive years, preferably 20 or more. These are businesses with the earnings consistency and management discipline required to sustain and grow dividend payments through recessions and market cycles. A 20-year dividend growth record is one of the strongest signals of business quality available in public markets. Lesson 2 is about why Buffett never chases yield, and the specific trap that high-yield stocks set for income investors. High yield is usually a warning, not an opportunity. The principle. A stock yielding 8 or 10% when similar businesses yield 3 or 4% is not an undiscovered opportunity. It is the market communicating that something is wrong, either with the sustainability of the dividend, the health of the underlying business, or both. Dividend yield is calculated by dividing the annual dividend by the stock price. A high yield can occur in two ways. The dividend was recently raised significantly, or the stock price fell significantly. The former is genuinely positive. The latter, which accounts for most very high yields, is a warning signal disguised as an opportunity. How Buffett avoids this trap. When a stock's yield spikes due to a price decline, it almost always means the market has identified a risk to either the business or the dividend itself. Buffett's response is to investigate the cause of the decline, not to simply buy the yield. If the underlying business is genuinely impaired, declining earnings, rising debt, weakening competitive position, the high yield is a mirage. A dividend cut will follow, the stock will fall further, and the income investor who bought the yield will experience both capital loss and income loss simultaneously. Buffett experienced this discipline in reverse with Berkshire's own policy of not paying dividends. He made the explicit calculation that retaining earnings within Berkshire, reinvesting them at high rates of return, would ultimately produce more wealth for shareholders than distributing them as dividends. He was right. Berkshire shareholders who wanted income could always sell small amounts of stock at prices that reflected decades of compounded retained earnings. What you do. When a stock's dividend yield appears unusually high relative to its peers, investigate why before buying. Check the payout ratio, dividends as a percentage of earnings. A payout ratio above 80 or 90% suggests the dividend is at risk if earnings decline at all. Check the debt levels. Companies with high debt often maintain unsustainable dividend payments to attract income investors while their financial position deteriorates. High yield is worth investigating. It is not worth assuming it is safe. Lesson 3 is the one I promised, the reframe that changes how dividend yield should actually be measured, and why most investors use the wrong number entirely. Yield on cost, the only number that matters long-term. The peak insight. We introduced yield on cost in the setup section, but the full implications of this concept deserve deeper examination, because they are more powerful than most investors initially appreciate. The conventional dividend investing framework asks, what yield can I buy today? Buffett's framework asks, what yield will I earn on my original investment in 20 years? These are completely different questions. And the second question, which almost nobody asks, is the one that generates the extraordinary outcomes visible in Berkshire's dividend portfolio today. The Coca-Cola illustration in full. Let us trace the Coca-Cola dividend growth precisely. When Buffett began buying Coca-Cola in 1988, the annual dividend was approximately $0.075 per share, adjusted for subsequent splits. By 1994, when his buying was largely complete, the dividend had risen to approximately $0.115 per share. In 2000, the dividend was 17 cents per share. In 2010, it was 47 cents per share. In 2020, it was $1.64 per share. Today, it is approximately $1.94 per share. On Buffett's average cost of roughly $3.25 per share, that $1.94 represents a yield on cost of approximately 60%. But the wealth creation goes further. The stock price itself has grown from $3.25 to over $65 today, a capital appreciation of approximately 1,900%. So Buffett holds an asset that has appreciated nearly 20 times in value and is now paying him 60% of his original purchase price in cash every single year. This is not magic. It is the mathematics of holding a great business with growing dividends for long enough that both the dividends and the stock price compound into something extraordinary. What you do. For any dividend stock you own or are considering, calculate what your yield on cost will be in 10 and 20 years, using realistic assumptions about dividend growth. If the company has grown its dividend 8% annually for the past decade, and you expect similar growth, a stock yielding 2.5% today will yield approximately 5.4% on your original cost in 10 years and 11.7% in 20 years. This projection is not guaranteed, but making it explicit changes how you evaluate current yield. A stock that looks modest today at 2.5% may be building toward extraordinary yield on cost if the business is genuinely strong. A stock paying 7% today with no dividend growth will still be paying 7% in 20 years, while inflation has eroded its real purchasing power significantly. Lesson 4 is about reinvestment, and the specific decision Buffett made about how to handle dividend income that multiplied its long-term impact. Reinvest early, collect later, the two-phase strategy. The principle, one of the most important and underappreciated aspects of Buffett's dividend approach, is that he does not consume the dividend income from Berkshire's portfolio positions in their early years. Instead, all income flows back into Berkshire, which then deploys it into additional investments, acquisitions, or the operating businesses. This is the fundamental two-phase structure of wealth building through dividends: an accumulation phase where dividends are reinvested to compound faster, and a collection phase where the accumulated income becomes genuinely passive cash flow. Most retail investors do not separate these two phases consciously. They either spend dividend income immediately or reinvest it haphazardly. Buffett's systematic reinvestment through Berkshire's capital allocation machinery is what transforms modest early dividend income into the billions collected today. How Berkshire applies this: when Coca-Cola pays Berkshire a dividend, that money does not sit idle. It goes into Berkshire's general funds and is deployed wherever Buffett and his team identify the highest return opportunity, whether that is buying more stock, acquiring a business, funding Berkshire's insurance operations, or building cash for future opportunities. This systematic recycling of dividend income means the compounding effect is not just on the dividends from Coca-Cola, it is on everything those dividends then purchase, which themselves generate income which is reinvested again. The result, visible over 6 decades, is that Berkshire's portfolio generates dividend income so large that it now comfortably funds Berkshire's entire operating expenses and capital needs, with billions left over. What you do, if you are in the wealth-building phase of your life, not yet dependent on investment income, treat every dividend payment as an investment capital injection, not as spending money. Systematically reinvest dividends either into the same stock, into other high-quality dividend growers, or into index funds. The mathematical difference between reinvesting dividends over 20 years versus spending them is enormous. Typically, the difference between doubling and tripling your wealth versus growing it by a fraction of those amounts. Lesson 5 is the final one, and it explains why Buffett considers the patience required for this strategy to be its most underappreciated and most difficult ingredient. Time is the multiplier, why most people never get there. The honest truth: the mathematics of Buffett's dividend strategy are not complicated. Buy great businesses with growing dividends. Buy at reasonable prices. Reinvest the income in the accumulation phase. Hold for decades. The execution, however, requires something most investors cannot sustain over the timeframes required. Holding Coca-Cola for 36 years means holding it through the new Coke backlash of 1985, before Buffett bought, but he knew the history. It means holding it through the 2000 bear market when the stock declined 30%, through 2008 when it declined 26%, through every moment when financial media reported that the growth story was over, that younger consumers were abandoning sugary drinks, that Pepsi was gaining market share. In each of those periods, the psychologically comfortable action was to sell, to lock in gains, to avoid further pain, to rotate into whatever was working at the time. The psychologically uncomfortable action was to hold, to trust the analysis done 10 or 20 years earlier, to believe that the dividend would keep growing, to wait. Why most investors never achieve this? Buffett has identified the core reason most investors fail to capture the mathematics of long-term dividend compounding. They optimize for short-term emotional comfort rather than long-term wealth creation. Selling feels like control. Holding feels passive and sometimes frightening. The natural human response to a stock declining 25% is to consider whether the thesis has changed, and in many cases to conclude that it has, even when the underlying business has not changed at all. The discipline to distinguish between a price change and a thesis change, and to hold through price changes while the dividend keeps growing, is rare precisely because it requires ignoring what every short-term market signal is telling you to do. This is why Buffett credits his extraordinary dividend income not primarily to analytical skill, though the initial analysis mattered greatly, but to the patience to allow the mathematics of compounding to work over the timeframes required. He calls compounding a miracle. But like most miracles, it requires a long wait before the miracle appears. What you do: for every dividend position you hold, write down the thesis. Not just, this is a good company, but specifically what metrics you are watching that would indicate the dividend growth story has genuinely changed. Rising payout ratio above 90%. Earnings declining for 3 or more consecutive years. A genuine structural shift in the business's competitive position. With those specific criteria defined, you can distinguish between a price decline that is irrelevant to the thesis, hold, and a fundamental change that invalidates the thesis, sell. Without those criteria, every market decline becomes a potential sell trigger, and the compounding never gets the time it needs. 5 lessons. 1 strategy. $6 billion a year, arriving quarterly without a single trade. Let's bring it together. Lesson 1. Buy dividend growers, not high yielders. The stock paying 2% today with 8% annual dividend growth will outperform the stock paying 6% today with no growth, dramatically over 15 to 20 years. Lesson 2. High yield is usually a warning. When a stock's yield looks too attractive relative to its peers, investigate before buying. Payout ratio, debt levels, and earnings trends will tell you whether the dividend is sustainable or a trap. Lesson 3. Yield on cost is the only number that matters long-term. Not the yield the market offers today, but the yield your original cost will eventually earn as dividends compound over decades. Buffett earns 60% annually on his original Coca-Cola investment. That did not happen in a year. It happened over 36 years of holding while the dividend grew. Lesson 4. Reinvest early, collect later. In the accumulation phase, every dividend payment is investment capital, not spending money. Systematic reinvestment is what transforms a modest 2% yield into an extraordinary yield on cost 2 decades later. Lesson 5. Time is the multiplier. The mathematics are not complicated. The patience required to let them work is rare. The investors who sustain it for the full time frame required are the ones who eventually receive the dividend income that looks miraculous from the outside. Here is the thing worth remembering about these $6 billion in annual dividends. Buffett did not receive most of them in the early years. He collected relatively small dividends from Coca-Cola in the late 1980s and 1990s. The extraordinary income arrived gradually, growing each year, until it reached a scale that now funds a significant portion of Berkshire's operating expenses without anyone lifting a finger. That is not a strategy available only to billionaires. The same mathematics: buy great dividend growers at reasonable prices, reinvest systematically, hold through price volatility, wait, work at any portfolio size. The percentages are identical whether the portfolio is $10,000 or $10 billion. What Buffett has is not secret information. He has the patience most investors never develop. This concludes week 6. Next week, we continue with a completely new angle on the series, one that looks at specific investment mistakes you might be making right now, drawn from the 60 years of documented errors we have covered throughout this series. That video is right here.